2 weeks ago, I said that I thought a slowdown in employment in the US gave the Fed room to cut rates. And last week, the Fed met and they cut rates. But what I also learned from that meeting was something I'd previously learned when Deputy Governor of the Reserve Bank of Australia came and gave a presentation for us. Andrew Hauser gave a presentation for us. And what he said was that there was no general theory of how central banks operated. What central banks actually do is that they look at the data when they meet and they decide on what that data really is. For the Fed, we've seen the impact of that data from looking at their summary of economic projections, which they released just after that meeting. The summary of economic projections shows the combination of the views, not just of the people who are working in Constitution Avenue, but of all of the Fed presidents around the US, whether they are present at that meeting or not. What we see is the actions of the Fed show how much the data has changed since the middle of the year. We can see how the data has changed and how it affects their views by looking at the difference between the outlook that was in the June summary of economic projections and the one that we've just seen released in September. In the September economic projections last week, the first thing was that the expected rate of growth of GDP for the year fell from 2.1% to 2%. More importantly, for our model of the Fed funds rate, and indeed expectations of the Fed funds rate, was that the outlook for unemployment at the end of the year rose from 4% inflation in the US to 4.4%. I've explained before how when unemployment goes up for our model for the Fed funds rate or for the Australian cash rate, that puts downwards pressure on where we think rates should be in the future. What also happened was that the expectation for inflation for this year fell. So the PCE deflator, which is the US measure of inflation that the Fed uses, which runs about 50 basis points lower than CPI. Instead of an expectation of 2.3% for the year, their expectation fell to 2.1%. That's equal to a CPI of about 2.6% at the end of this year. Interestingly, the RBA doesn't expect to get into that range until 2026. At least that's what Michelle Bullock was talking about on Tuesday. For core PCE, the Fed expectations fell from 2.8% to 2.6%, which is similar to falling to 3.1% on the CPI. As a result of that, their expectation of where the Fed funds rate would be at the end of the year changed quite dramatically at the meeting. Prior to this meeting, they expected that in the June summary of economic projections, that the Fed funds rate at the end of this year would be 5.1%, which means by the end of this year, they were only going to cut rates by 25 basis points. Now, in what way they've released last week, because of the increase in unemployment and because of the fall in expected inflation, they thought that the Fed's funds rate at the end of the year would end at 4.4%. That's a 100 basis point rate cut, including what they've just done. Now, we've had a 50 basis point rate cut in the Fed funds rate last week, so expect there will be another 25 basis point rate cut in November by the Fed and another 25 basis point rate cut in December for the Fed, so that the total cut in the Fed funds rate is 100 basis points. So in answer to the question, what is the Fed going to do now? The Fed is going to give us 2 more rate cuts, one next month and the other the month after. And those rate cuts will continue through next year. Exactly when and how big, we don't know. But it's important to understand that those cuts in the Fed funds rate are only possible because at the same time, the Fed is continuing quantitative tightening. This means they're selling off the bond holdings that they've acquired. They acquired up to $9 trillion worth of bonds and other assets to reflate the US economy during the pandemic. And they've been running those assets down at around $1 trillion a year. Now those assets have fallen to $7 trillion. We expect they'll continue to run off those assets until they're down to about $4 trillion, which could take at least another 3 years, and they could go even lower. That means it's $1 trillion a year of quantitative tightening that offsets the cut in rates. It generates a reduction in the money base, which puts downward pressure on inflation, and that lets the Fed Reserve cut rates. So it's the combination of things. But it's important that when you compare the situation that the Federal Reserve is in now to where the RBA is in now, we'll go back and look at those things. The most recent level for the trimmed mean in the US is for a level of inflation of 3.2%. Including the other components, including unemployment and inflationary expectations, we estimate the Fed funds rate should right now be at an equilibrium level of the Fed funds rate, should right now be 3.1%. So that means there's plenty of room for the Fed funds rate to fall over the next year. The problem is that when we do an RBA model using those same elements, inflation is higher than in the US. Australian core inflation is 60 basis points higher, 0.6% higher now than it is in the US. That means that the equilibrium level for our cash rate model now is 3.9%. That's only slightly below the 4.35% where the cash rate is now. So falling inflation in the US gives us a low equilibrium level for our Fed funds rate model and allows the Fed to cut. But inflation isn't falling in Australia. That means that our cash rate model estimate is significantly higher. And therefore, it's more difficult for the RBA to cut than it is for the Fed to cut. Again, there were quite dramatic changes in US unemployment expectations. US unemployment expectations rose from 4% to 4.4%. But at the end of the year, the PCE deflator fell with core inflation now expected to be at a PCE level of 2.6%, which is equal to 3.1% in the CPI. And the expected Fed funds rate at the end of this year fell from 5.1% to 4.4%. All of which means that the cuts we've got from the Fed will be followed by further cuts next year. But unfortunately, inflation in Australia is too high for the RBA to follow.